Hello everyone, hope you weren't caught off guard by the sell-off during the end of last week. As shared in my previous video, investors can expect big movements in the weeks and months ahead, and also how bearish the market is with so many death crosses on the stock charts. So in this video, I will continue to share my view on what to expect in the upcoming week or weeks ahead, and as usual, I will also provide some simple technical analysis for some of the various mega cap stocks. And I have also decided to include my option trades for viewers who are into option trading. Once again, if you like such videos, I hope you can help me with the like and subscribe buttons. Your small action means a lot to me and the YouTube algorithm. Alright, a quick recap on last week. I have posted on Moomoo that the market was in the consolidation phase earlier in the week and was waiting for a big movement. And true enough, the market made a big move towards the end of the week. So it appeared that the market makers have chosen the direction even before Friday's CPI report. There was a huge sell-off at the end of Thursday's trading hours for almost all the stocks. Probably someone knew something we didn't know. And guess what? The CPI's data announced on Friday turned out to be really bad, as the CPI number is higher than expected. This means that inflation has not peaked in the last few months. The latest figure of 8.6% is the highest since 1981. As a result of the CPI report, the market continued its sell-off on Friday. As I have always shared, let the market makers go first, and we, the retail investors, follow right behind them. Therefore, those who have followed the market makers' direction and bought put options when the market opens on Friday, you would have profited quite a fair bit. So, credits to you if you are one of them. And to be transparent, I didn't buy any puts because buying puts is just not my investment or trading strategy, at least for now. Moving on, there are two potential landmines in the upcoming week. The first one would be FOMC meeting on 14 and 15 June, while the second one is quad reaching day on 17 June. But if you are not a trader, the latter shouldn't concern you too much as you would care more about the broader market. So I will skip explaining the quad reaching day. But the long and short is that we can expect higher volatility and volume on that day. For FOMC meeting, in case you are not aware, the Federal Reserve is expected to raise the interest rate by 0.5 basis point this and next month. But now with the high CPI data, there are speculations that the Fed may increase the interest rate higher and at a faster rate to curb inflation. And when the Fed does this, there is a high risk of causing a recession. To be frank, for the Fed, the ideal scenario is to raise the interest rate steadily, then see the inflation goes down, while at the same time the economy does not go into recession. This is what we call soft landing. But given the current situation, I would think it's very difficult to achieve that. I have shared several times in my previous videos that the market is not ready to pivot from the current downward trend, especially when the Fed is still hawkish. And I'm going to be a little naggy here and repeat that again. I mean, looking at the current status, it further confirmed that we are nowhere near the end of this bearish trend. If anything, we could be and potentially be still at the beginning of a bearish market. But this is not a financial advice, of course. My intention is to caution investors to stay cautious under the current climate. Yes, we all know the market will go up eventually someday, but sometimes it doesn't pay to be a permanent bull. In short, don't be a bull in a bear market. That said, if you are feeling nervous about the current bearish market, you may want to check out my other video on what to do in a market crash. Hopefully, it can give you some positivity despite the negativity in the market. Alright, enough of talking, let's move on to the technical analysis bit. Here's a quick look at VIX. In my previous videos, I shared that the support level for VIX is around 25. If it breaks above that, we will see a fair bit of sell-off in the market, which happened on last Thursday and Friday. So now what should we look out for in the upcoming weeks? Two key levels. First is this downward trend line marked by the red line, which acts as a resistance for VIX to go up. This level is around 29. The next level is around 31, where the top of the Bollinger Band is. If VIX hits and breaks above these two levels, you can expect further bloodbath. On the other hand, if the market has any form of relief rally, the support level for VIX is 25. If it goes below that, good for bulls. If not, the whatever rally we have is gonna be a weak one. Now let's have a look at SPY. It broke downwards out of the consolidation zone as marked out by the two blue lines. It seems like it's currently heading towards the bottom of the Bollinger Band, which is around 385. If that breaks, the next key support level is the recent low of 380. Looking at the RSI chart, it is currently on the verge of curling downwards, which means there could be more downside. As a result, I am of the view that both levels 385 and 380 will be tested. And if the market continues its sell-off after FOMC's meeting, I would think SPY will test this downward trend line marked by the long red line at around 360's range. To add on, interestingly, there was this huge transaction on put option on Friday. Someone or some institution bought a SPY put with a strike price of 372, expiring on 15 July. When you add up the figures, it's more than 7 million worth of transactions. And in case you are not aware, this is a bearish move, where the buyer predicts SPY will move towards the 370s range within the next 1 month. Someone knows something that we don't know? But then again, a quick disclaimer, the buyer can still make profit without SPY hitting 372, or he or she may roll over the option if needed. That said, to me, this just shows how bearish the big players perceive the market to be. Next, Apple. Interesting chart here. The MACD shows that it wants to go down, together with the bearish market. But then, it is at the bottom of the Bollinger Band, and usually when it tested this area, it will bounce up a little. So I'm not gonna guess how it is going to move next week, as we still have a huge landmine from FOMC meeting. So what I will do is to keep a lookout for some of the key levels. If the stock bounces up, the first level to watch is the support turn resistance level at 140, and also the gap from 140 to 142. In my view, I think if there is any form of rally, the stock will likely fill the gap and then head back down. On the other hand, if FOMC throws in the bomb and there is no rally, look out for the bottom of the Bollinger Band and the red downward trend line around 136 to 137. It appears that this was holding firmly towards the second half of Friday, so let's see if it holds next week. If it doesn't, then I think it will flush down quite quickly to test the recent low of 132. Anyway, on 15 May, about a month ago, I have shared in my video that there could be a potential head and shoulder pattern forming on the weekly chart. And if that happens, the stock will be very bearish. So now let's revisit this again. And it seems like it is still on track to form the pattern. Once the pattern is confirmed, I believe 120's range will be in play. Next, for viewers who are into options trading, here's a segment for you. I have shared in my last video that I sold 2 put contracts for Apple, where one expired on 3rd June while the other was pending expiration on 10 June. As of today, the contract for 10 June has expired too. As you can see, I sold 2 put contracts at strike price of 130, and Apple did not fall to that price by both expiration dates, and as a result, I got to keep both premiums. Not a lot of money, but good enough for me to buy some Starbucks drinks this month, aka kopi money. With the 2 contracts being expired worthless, naturally I would want to open new positions for more coffee money next month. So on Friday, when the market was experiencing bloodbath and Apple broke below 140, I quickly sold another put at key support level of around 137. But this time round, it was with a lower strike price at 120, which I had also shared in my previous video. As usual, quick disclaimer, this is not a financial advice, so please do not follow blindly as I have some plans in mind if the trade goes haywire. So for the purpose of transparency and spirit of sharing, here are my plans. Firstly, I am prepared to snap up 100 shares of Apple at 120 if it falls to that price. And with these 100 shares, I can start selling covered calls to ride on this bearish market trend. Secondly, the stock had a 2 days of massive sell-off towards the end of last week, and I think that could be a relief bounce up temporarily in the next 1 week or 2 weeks. And that happens, I may just close my position for some profits. Lastly, let's say if the stock crashes and if the market is super duper bearish, I may just roll the option from 120 strike price to 110 or $100. So these are the plans I have in mind, and that is why I recommend viewers not to follow blindly if you don't have your own plan. Anyway, if all turns out good, the stock stays above 120 in 1 month's time, I think the premium of 141 per contract I have collected is pretty decent in terms of ROI. Finally, I wish to highlight that selling puts in the bearish market is quite risky. You must be prepared to get a sign. most traders will prefer buying puts instead. The reason why I'm not doing that because I am not a fan of buying puts, which I'm not gonna elaborate too much here in this video, else it will be super lengthy. But yeah, logically and theoretically speaking, in a bearish market, buying puts is a decent way to hedge your portfolio. Anyway, the message here is choose a strategy that suits you and find your own road to Rome. Okay, for Tesla, I have been posting on Moomoo that 746 is a key resistance level that it needs to break above in order to be bullish. As you can see from the chart, it tested this level on several occasions and was consolidating around this range. Then it finally got rejected and went down with the broader market. On the downside, I really don't see much support at the moment, so I would think testing the recent low of 620 is very possible. That being said, Tesla had announced a stock split, and if investors see this as a catalyst in the short term, there could be a small rally. Resistance could be of course the psychological level of $700 and the first Fibonacci level at 746. In my view, I think below 650 is a good entry point for a long-term hold, and if it goes further down to 500's range, I will accumulate even more before the stock split so that I can do covered calls later. Moving on to Microsoft, the stock showed lots of weakness as compared to the other mega cap stocks. RSI is curling down too, and there could be more downside, though not guaranteed. I have shared in many of my videos that the significant consolidation zone is 200 to 220. That being said, personally I feel that the recent lows of 240 could be an area to accumulate some shares if you believe in the long-term trajectory of the company. If the stock were to retest the recent low of 245, do note that there is a little gap between 244 to 245 pending to be filled. On the weekly chart, if it breaks 238, which is the 50% Fibonacci retracement level, then I think it is very likely we could hit the low $200 consolidation area. At this point, it appears that new sellers are stepping in to sell off Microsoft, hence the massive weakness in the stock. But that's just my view, I could be wrong. Okay, some quick end thoughts here. At the moment, I think we are going for another leg down, but this is not a financial advice, alright? To me, the Fed has to be more hawkish to bring inflation down, and the more aggressive they are in doing so, the more pain we will experience in the stock market. I am not sure how low this market can go, but I have previously done a video on prices where I will snap up some stocks if a true capitulation happens. Meanwhile, there are really very few or almost zero reason for me to be bullish about the market. We could potentially have a rough summer ahead, so do stay cautious and invest safely. Once again, if you are long-term investors and feeling jittery, check out my other video on market crash. Then take some time off the rate market for a while. The market will go back up, it definitely will, it's just a matter of time. Alright, that's all for this video. If you have found some value in this video, I really hope you can hit the like and subscribe buttons. They mean a lot to me and will keep me going. Thank you very much.